Here's what happened to somebody that just came to us and wanted some help. What if I tell you that the IRS will tax you for changing the type of entity you currently are from a simpler type of entity? What do I mean by that? Let me explain. When you change the kind of entity you are, especially if you are an S corporation, and if you are trying to convert, even if you are a C corporation, and if you're trying to make this a disregarded entity, there's going to be tax consequences. Let me explain by a story of an individual that reached out to us recently and what happened with them. So during 2020 pandemic, a lot of people were selling their multifamily assets, and these individuals, two partners, they bought an asset for about $1.2 million. Rates were cheaper, so they got pretty good cheap debt, although the debt was adjustable, so it went up in price as the time went by. So at the time, they had cheap debt, they had plenty of cash flow, taxes were under control, insurance was under control, so they had pretty good positive cash flow. So they continued to keep that property. Their CPA also advised them to do bonus depreciation, take advantage of cost segregation. So they took advantage of that and then wrote off around $500,000 of the $1.2 million they invested. Fast forward to 2024 now, they are not cash flowing because their interest rates are gone up. Their vacancies are high, insurance is high, taxes are high. So they are spending about $4,000 a month out of pocket to pay for expenses because the cash flow is just not enough. Here's what happened. They were trying to figure out ways to adjust their expenses, and they were spending about $1,500 in just corporate filing every year, the S corporations. They were partners, right? So somebody suggested them just convert this into disregarded entity, and without giving too much thought into this, they went ahead and converted that into a disregarded entity. And what happens next? The IRS treated changing from an S-corp to a disregarded entity as a form of sell. Even though they didn't sell anything, the transaction of converting from an S to a disregarded entity is considered as a sell, and they got a tax bill. What's important over here to understand for anybody out there is you cannot just convert from an S corporation to a disregarded entity because it is easier to do taxes for disregarded entities. Yes, it is. There are less rules, but if you have an asset under a S corporation, then this becomes a taxable event. And if you're going to do that, then you're going to get a taxable tax bill for things that you did not actually do. You did not sell anything. You do not have the cash. That's why you were trying to make it a disregarded entity so you can save some money in fees, expenses every year. But the opposite happened. And now this property is considered sold. Something that is now less in value, a $1.2 million property is probably worth about $900. On top of that, you cannot find a buyer. You cannot get a cheaper financing. And now you have a tax bill and the whole $500,000 that they depreciated. Now they are going to owe tax on it. And it's roughly around $200,000 that they both have to come up with to pay the tax, plus the state. So about $175,000 on roughly for $500,000 of gains. The whole depreciation that took the $500,000 at 35%, it's about $175,000, and the state wants another $25,000. That's about $200,000 for something they did not do. All they were trying to do was change it from a S corporation to a disregarded entity, but it triggered a tax. And even if the IRS wants to be sympathetic to their situation and understand what's going on with them, they cannot fix it. They cannot change it. They're just simply following the law. And now they have to come up with the money. So they are now in a payment plan. They're paying around $3,000 a month towards the tax debt, with interest and penalties piling up every single day. So the lesson over here is this: you should not be taking advice from people on the internet that are trying to make content just to fill in their calendar. Tax professionals are on their own side. We have the best qualified people in our team, and anytime a client of ours that makes a tax election, or they're trying to make a change in their taxes, they always consult us. And it's just a call away, just an email away, but that gives them the exact detailed information they need. And we look at it from our perspective to where it's not going to trigger a tax event for them. And we think our clients or other people would know the nuances of these things. Surprisingly, a lot of people don't know about it. And that's okay, because tax code is complicated, but someone needs to look out for you. Our clients that do taxes for, between their business and their personal taxes, their tax return is about 500, 400, 600 pages long between their corporate returns and their personal. So it's complicated and it requires very close attention, and you cannot just make decisions on the go. And that's something for anybody to remember, is you need to make sure that you have somebody you can call before you ever make a decision like that, because it can trigger tax events and that can be devastating for your situation. I hope that helps. I hope you find somebody who can help you, and always consult somebody before you make such decisions, because that's $200,000 should not have been there they never sold the property, they're underwater, they're negative almost $7,000 every month in cash flow, but they still owe the tax, and the IRS cannot help them because they're simply trying to follow the law that the Congress, the Treasury gave them. That's it. That's all for now. I hope that helps. We'll see you guys on the next one.